Well, FNB's quarterly property review out today, and it looks like the residential market is deteriorating following a pickup at the beginning of the year. FNB's estate agent survey for the second quarter shows agents pointing to weaker demand than that of the first quarter, and it's taking longer to get houses sold too. Well, joining me in studio now is FNB property strategist John Loos. John, thanks for coming in.
It's a pleasure, Stephen.
John, surprising trend that we should see a dip between the first quarter and the second quarter, particularly ahead of the World Cup, when I would have thought confidence would have been boosted.
Stephen, I don't think the World Cup makes too much difference to the short-term prospects for property. There's bigger matters, the overall economic cycle. So it doesn't surprise me too much. I thought maybe it would hold on for another quarter or so, but yes, activity levels down according to agents surveyed in the second quarter, and with it, average time on the market shooting up from 12 weeks and 4 days average to 17 weeks and 1 day, which is very significant. So it's taking longer, which suggests an increased mismatch between supply and demand. Now, regarding the World Cup, that was a tough one. The agents, a lot of them cited the World Cup as a factor in their near-term expectations as they were surveyed. That survey took place just before the World Cup. Some of them were saying that it boosts sentiment and therefore is good for property buying. Others were saying that it's distracting the country and they're not looking for property at the moment. They're getting caught up in this whole World Cup holiday. So difficult to ascertain whether there was any, on a net basis, whether there was any positive or negative short-term impact for the World Cup.
Would you see any longer-term benefits from the World Cup, though, do you think? Do you think people might have come here to see the World Cup and thought, hey, great place to buy a house?
I don't think there'd be too much of that, but definitely a lot of positive implications, potential implications. I think the perceptions towards South Africa have been dramatically boosted. A lot of Afro-pessimists around have been pleasantly surprised. That should boost interest in the country, be it investor interest, be it tourism interest over the long term, making it more than what it otherwise would have been, and that can add a little bit extra onto long-term economic growth. So I think there are a lot of potential positives out of the World Cup, but that's the longer term. In the shorter term, I think there's a slowing economic cycle at the moment, economic growth cycle starting to take place, a lack of further interest rate stimulus, and I don't think a World Cup benefits can do much to slow that short term, or to stop that short-term down cycle.
Well, you mentioned a mismatch in pricing. Do you think at the beginning of the year, when we saw the property market starting to recover, that people got unrealistic expectations of what they could fetch for their properties?
I think there's been a lack of realism. It has improved since demand started picking up early last year. But that improvement in realism was probably not due to the deliberate attempts of sellers to be more realistic, but more due to demand actually at that stage catching up with the market. Stronger demand, and so putting more upward pressure on prices. So that average time on the market dropped. Now it's the other way around, demand starting to deteriorate again, and up goes the average time on the market. So the mismatch has got a little bit worse again.
Of course, over the past few months, we've had the European crisis escalating. We've also had talk of double-dip recessions. Do you think perhaps investors in the property markets are getting a bit more anxious about where the global economy is heading?
I'm not sure most investors in the property market think about where the global economy is heading. It's more a case of, can I buy a house? Overwhelmingly, it's primary residential demand driven. I need a house. I want to live there, and that's what drives me. The non-essential, the sort of more investor items, the holiday properties, the buy to let, they're not really a significant focus at the moment. But what is the reality is that we're still a highly indebted household sector. There's significant financial pressure on the household sector. And so if economic growth is going to slow, that means real disposable income growth slows, and that brings back more pressure. So that's really more the reality. I don't think households as a whole look at the global economy and say we're worried about a double dip. Having said that, I do think the risks of a double dip are significant. We can't ignore the bad numbers in the US, the high debt levels, and all the imbalances in the world economy at the moment.
And do you think this could be a global double dip, or do you think it'd be restricted to areas like the European Union?
I'm more concerned about the United States. The European Union has been the focus recently because of Greece, but some of those countries that are in trouble are relatively small fry. The United States itself has been running on 0% short-term interest rates, massive fiscal stimulus. What happens when all that gets pulled away? Because it can't carry on like that forever. The US is the biggest economy in the world still. It's the most important, and what happens there is crucial.
Well, does taking interest rates to abnormally low levels then just postpone the pain, and in that case Should we be cutting interest rates in South Africa, or should we be learning to live with interest rates where they are?
I think I think we must be careful what we wish for. The cutting cycle early last decade, to where the Fed funds target rate in the US was 1%, I think that was helping to set the US up for the ultimate crisis. The hiking, when the hiking phase started, that's where the trouble came. And you've always got to ask with interest rates is, if you are going to cut to abnormally low levels to stave off a painful period, what happens thereafter? You may have an abnormal magnitude of hiking. You get an economy used to borrowing at abnormally low interest rates, then you hike by an abnormal magnitude, you can get yourself into trouble. So I think we've got to be careful what we wish for, and the SARB will probably be mindful of that.
So it's probably best to keep them steady for a longer period rather than taking them down and then having to hike them again sooner.
I think so. They've got to be careful from here onwards.
How about banks' lending criteria? Do you think they're appropriate at this stage? We know that they're not as easy to lend as they were a couple of years ago, so many customers perhaps not getting those home loans. Do you think it's appropriate for where we are at the moment?
By and large, I get the impression they are. Banks do have to consider the global risks and the local economic risks. Stephen, even if banks were as relaxed as what they were 4 or 5 years ago when they were at their most relaxed in the cycle, the reality is that, I think still far less households would qualify for loans even with those criteria, because the household sector is just a much more financially pressured sector now than what it was 4 to 5 years ago. So to lend aggressively to a household sector under pressure, that's taking chances.